So welcome back to my banking class. So in this chapter, we discuss about the definition of a banker, definition of customer, then what are the duties of a banker, and then we discuss about the features of RBI Bank, Reserve Bank of India. We also discussed about the Banking Regulation Act 1949 in our previous classes. In this class, we'll be discussing about Reserve Bank of India credit control measures. Okay, so under this, there is two method uh, followed by Reserve Bank of India. One is quantitative or a general method. The other one is a qualitative or a selective method. Under quantitative or general method, we have bank rate, open market operations, variable cash reserve ratio. Under qualitative or selective method, we have margin requirements, credit rationing, regulation of consumer credit, moral suasion, and publicity. Now we discuss about the quantitative or general method. These methods governs the lending power of the financial sector of the whole economy and do not discriminate among several spheres of the economy. The crucial quantitative methods of the credit control are. So the idea behind this credit control is to have a stable economy. So the economy stability can be, can be controlled in one way or another by the different banks. Okay, like commercial bank, public bank, cooperative bank, and all those things. So if the Reserve Bank of India, which is a central bank for all this bank, they have implement proper credit control, then our economy will be more stabilized. So that's why they have this credit control measures. So the first one, we see bank rate policy, the standard rate at which central bank is ready to buy or rediscount bills of exchange or other commercial paper eligible for purchase under the provision of the Act of RBI. Thus, the Reserve Bank of India rediscounts the first-class bills in the hands of commercial banks to furnish them with the liquidity in case of a need. So, whenever a need arises, so what happens? The central bank, Reserve Bank of India, they rediscounts the bills. Okay, so the bank could maintain some liquidity for their smooth operations. Second one is open market operations. It means of enforcing monetary policy by which RBI controls the short-term rate of interest and the supply of base money in the economy, and thus indirectly the total supply of money. In times of inflation, as you know all, what is inflation? Inflation is nothing but the increase in the prices of a product or commodities. So what will happen? The increase in product of the this thing, then the people have to spend more money, so they will have a financial crisis. Especially if the prices of the common commodities like rice, vegetables, petrol, all this goes up, then what happens? Then it will affect the common public. So in times of inflation, RBI sells securities to finish off the excess money in the market. So when the prices of the items are going up, that's during inflation, the Reserve Bank of India, they sell the securities to clear the excess money. Thereby it will stop the inflation. Similarly, to increase the money supply, the RBI purchases security. When the supply of money in the economy is facing shortage, they will do the purchase of the security. So there will be more money flowing in the economy. So depending upon the situation, whether it's inflation or short supply of money, they either sell the security or they buy the security. So the third one is a variable reserve ratios. So variable reserve ratios refer to the proportion of a bank deposits that commercial banks are required to keep in the form of cash to ensure liquidity for the credit created by them. So this means that this will variable reserve ratio will give what do you say idea or landmark or something to decide how much money a bank can keep in the form of a deposit, especially in the credit, especially in the commercial banks. This to ensure that they have enough liquidity for credit created by the banks. A rise in the cash reserve ratio results in the fall in the value of the depositor multiplier. Conversely, a fall in the cash reserve ratio leads to rise in the value of the depositor multiplier. So whenever there is increase in the cash reserve ratio, this will lead to the value of the depositor, decrease in the value of the depositor multiplier. In the same way, if there is a fall in the cash reserve ratio, this will lead to the increase in the value of the depositor multiplier. So a fall in the value of depositor multiplier amounts to a contraction in the availability of credit. So whenever there is the value of the depositor multiplier goes down, what happens? It will lead to the contraction. Okay, to the availability of credit. Contraction means a lessening or lessening availability of the credit, and thus it may serve as an anti-inflationary measure. So this actually will lead to anti-inflationary. As we have seen, inflation is a increase in price of the commodities. So this, reduce or fall in the deposit multiplier will lead to the contraction of credit availability, and then this will control the inflation. That is a anti-inflammatory, means something which controls the inflation. So this is actually do good for the economy and for the common people, common man. Then there's a first method. Sorry, second method is a qualitative or a selective method. The qualitative or selective methods of credit controls are adopted by central bank in pursuit of economic stabilization. Okay, again, this is the second method, which is a qualitative or selective method. This is implemented in order to by the Central Bank of India, that's RBI, in order to, the objective is to stabilize our economy. Okay, and then this is possible through the proper credit management system. So the first one in the qualitative or selective method is margin requirement. Changes in the margin requirements are designed to influence the flow of credit against specific commodities. So what happens? There will be a change in the margin requirement to influence the flow of credit against specific commodities. The commercial banks generally advance loans to their customers against some securities or securities offered by the borrower and are acceptable to the banks. So what happens? Whenever a customer take a loan in the bank, okay, especially commercial bank, they are required to deposit a security for the loan. Okay, so as you know, usually the security will be like a documents of properties, like they can give the document of their land or their house, okay, any kind of document. And that's usually for a big loan amount which go like more than lakhs of monies. So what happens, usually they require the documents as a securities. And then the common one for like in terms, if you borrow loan for like 1,000 to 50,000 or 100,000 or 30,000 like that, so usually the security will be in the form of gold. Okay, so these are the very common securities. And when they give, when they take the securities, usually the value of the security will be more than that of the loan issued to the customers. So more generally, the commercial banks do not lend up to the full amount of security but lend an amount less than that value. As you all know, that if they give a loan based on the jewel, gold jewel as a security, so it will be not that the full amount of the value of the jewel, the current value, because the price of the gold will go up and down. That's one scenario. Second, then when you really sell, when the banks sell, when they need liquidation, means the value will will little bit less. So what happens, in order to be safe side, they only give like a 70% or maximum up to 80% of the value of the gold. Say if they if the the person, customer who is want to borrow money, say 100,000, okay, then the value of the gold should be at least like hundred 1,20,000 or 1,30,000. Okay, so that is a minimum, and 30 to 30% lesser than the this thing. So that is what they say. So that the bank is safe side. The margin requirement against specific securities are determined by the central bank. So they take the banks, commercial bank, they take the help of the central bank to determine how much a margin they for the loan they can issue based on different types of securities, as we have discussed. It may be the gold, and then it may be the land. Same like gold. If the value of the market rate and the value of the if a particular document they produce, you say like 3 lakhs. Okay, so the loan will be usually given only up to 2 lakhs, something like that, based on the documents. And this margin, okay, based on the security, how much a commercial bank can issue to their customer is decided by the central bank. So the margin requirements against specific securities are determined by the central bank. A change in the margin requirements will influence the flow of credit. So when they either increase or they decrease, and then what happens? The flow of cash, either increases or decreases. Again, it depends upon the financial situation. That's the economic condition of the, country or the state or whatever it is. A change in margin requirement will influence the flow of credit. A rise in margin requirement result in contraction in the borrowing value of the security, and similarly, a fall in the margin requirement results in expansion of borrowing value of the security. So, like when they increase the margin value, then what happens? The borrowing of money against the security will increase. When they reduce the margin value, then what happens? The value of the money borrowed will increase in line with the value of the document. So again, this is decided by the central bank, which is nothing but a Reserve Bank of India. Okay, again they determine this what is the margin to be decided depending upon the economical situation of the country. Then it's a credit rationing. Rationing of credit is a method by which central bank seeks to limit the maximum amount of loans and advances, and also in certain cases fixed ceiling for specific categories of loans and advances. So this is like credit rationing means this is the one fixed by the central bank for the banks which are under them. Okay, so they will decide how much loan they can give to a particular bank. Okay, and what a ceiling, fixed ceiling means, what is a maximum amount a loan a central bank can give to a particular bank. So all these things are decided by the central bank, that's the Reserve Bank of India. Okay, so this they do in order to monitor how well the business a commercial bank is doing. Okay, if they are really doing well, then the amount of loan will be higher. If they are not doing well, then they will reduce the margin of money which they owe to the which they loan to the commercial banks under them. So the next one is a regulation of consumer credit. So regulation means that the monitoring and regulating the credit given to the consumer on the consumer goods. Regulation of consumer credit is designed to check the flow of credit for consumer durable goods. Consumer durable goods, as you know, like household items like phones, smartphones, TV, refrigerator, washing machine, and all those things. As you know, whenever you want to buy consumer goods, usually, either you pay the full cash or you go for the higher purchase. Okay, you just pay the initial amount, then the rest of the amount you will pay like EMI. Okay, and monthly installments. So what happens? This is regulated by the central bank for all the commercial banks. Again, this regulation is monitored. Depending upon the economic situation. Now, if you take instant the COVID-19 situations, the commercial bank have strict regulation and the monitoring on certain loan facilities for certain things. Maybe for personal loan, they may give little bit flexibly, but certain consumer goods or home loans, okay, they may not have that much leniency. Okay, they will have strict regulations because due to the poor economical conditions. So this can be done by regulating the total volume of credit that may be extended for purchasing a specific durable goods and regulating the number of installments through which such loan can be spread. So what happens? They not only, put restrictions on consumer durable goods depending upon the situation, but also the number of months you pay. Okay, if the situation is good, maybe they give the monthly installments maybe up to like 2 years, 24 months, or 36 months, depending upon the product and the country condition. At the time of economic crisis, the bank will regulate them to, the shorter duration. So instead of like 3 years, they may make it like 1.5 year, 18 months, or 6 months, or 1 year. Okay, so this way, the loan can be collected, in a short duration. So central bank uses this method to restrict or liberalize loan conditions accordingly to stabilize the economy. So the basic objective for the central bank or the Reserve Bank of India, either to liberalize, to make the credit flexible, or to restrict or regulate, is the basic idea is to stabilize the economy, as we understand from this. Okay, so the main objective is to have a stable economy. So moral suasion, suasion sorry, is actually the meaning of this word is to persuade a person or a group of people, okay, to change the attitude or something. That's a general meaning of moral suasion. But here, the moral suasion, when it implies or applicable to RBI, is that that is to monitor the credit control of the commercial banks which comes under them. Okay, so the policy of moral suasion will succeed only if the central bank is strong enough to influence the commercial banks. That's to ensure that they are particularly monitoring and regulating the credit given by the central government to the commercial banks or banks which comes under them. Okay, in India, from 1949 onwards, the Reserve Bank has been successful in using the method of moral suasion to bring the commercial banks to fall in line with its policies regarding the credit. So this is one of the very effective way, and it has been successfully implemented by the Reserve Bank, okay, in regulating the credit policy of the commercial banks which comes under them. Publicity, it's a method whereby the Reserve Bank marks direct appeal to the public and publishes data which will have sobering effects on the other banks and the commercial circle. So what happens? Another way, I mean, to control the credit is to send a direct appeal to the public and publishes the data which will have sobering effects, means a very serious effect. So what happens? The people and the banks understand the seriousness of the I mean the situation, economical situation on the banks and the commercial ones. So what happens when they notify the public and the banks, okay, regarding the situations and all those things, so that they really have control over and regulate the credit flow. So now we discuss about the credit control strategies done by the Reserve Bank of India and the central bank. Now we go to the last topic of this unit, the secrecy of the customer account. So this is one of the duties and obligation of a banker to maintain confidentiality and the secrecy of the details of their customer accounts. It is one of the principal duties of the banker to maintain complete secrecy of the status of the customer account, and failure to do will make the bank to compensate the customer for any damage or loss suffered. So if they fail to keep the information as confidential, then because of this, the customer incur any issues, then they have the rights to sue the bank. However, a bank is justified in making disclosure under due process of law or under express or implied consent of the customer. If the customer willingly or due to some other reason, the bank has a right to disclose. So disclosure in bank interest is permitted. So also it is an accepted customs among the bankers to disclose certain information to a fellow banker on a written request. Okay, if other bank request by writing to this bank, okay, so they have the discrepancy or right to disclose the customer information. While disclosing information to others, only bad facts should be revealed, not any comments and conclusions on the manner. The disclosing bank should indicate to the other bank that in turn it should maintain secrecy. So the bank where the customer is having account, when they disclose certain details about a customer to the other bank should promise that they will keep the information furnished by the bank where the customer is having account. They will promise that they will keep that as a confidential. Then only the bank can furnish the information to the other bank. So that's all for this chapter. Okay. In the next class, we will start with the new next unit, the second unit.